Is a recession coming, guys? People have been talking about this recession for a long time, the inverted yield curve, and people don't feel like a recession's here. Consumer confidence is high. Home prices are going back up. Unemployment's low. What is going on here? Now, remember, on this channel, my goal is to sit there and look at the data and say, what are the possible outcomes here? There's no guarantee of anything happening. However, the professor who talked about the inverted yield curve has been flashing the sign. It's 8 for 8 in terms of predicting a recession going back to World War II. Does that mean it's going to happen for sure? No. Back in 2016, no team had ever come back from a 3-1 finals deficit. And then the Cleveland Cavaliers on June 19th, 2016, the best day of my life, completed the most epic comeback against the best record ever in NBA history, 73-9 Golden State Warriors. What up? So let's check this out. Now, I learn something new every day. I always thought the inverted yield curve was comparing the 2-year and the 10-year treasury. So what does this mean? Inverted yield curve. When you lend somebody money, would you want a higher rate or a lower rate as you lend them money for longer periods of time? Of course, a higher rate. Why? Because you're tying up your money. There's more likelihood that things go wrong. So therefore, more risk involved. You should get a higher rate. And the shorter you lend money out, if I were to give you a loan for $100 for tomorrow, I might not even charge you interest. I'd be like, hey, give me $100.04. It doesn't even matter. But if you wanted $100 for 20 years, I got to charge you a higher rate because there's more likelihood that something's going to go wrong in those 20 years. But with an inverted yield curve, it means the short-term rate is higher than the long-term rate. So I always thought it was 2-year versus 10-year. The 2-year rate is higher than the 10-year. It means that people perceive more bad times in the next 2 years than the next 10 years. And 8 out of 8 times since World War II, that has properly predicted a recession. Now, that in and of itself does not cause a recession, but it's saying that, hey, listen, people are perceiving a lot of potential problems in the short run versus the long run. Okay? Now, what I learned is the professor who actually created this, Duke professor Campbell Harvey, it's actually the 90-day, the 3-month treasury inverted from the 10-year. So let's look this up right now. So this is the current yields on government debt. The 3-month yield right now is 5.43%. The 10-year is 4.15, and it's been that way for 8 months. But here's the interesting thing. He goes on to sit there and say, wait a second, before he's not willing to call it that it's a false positive, okay? It's a false sign. He sits there and says, listen, I'm happy with everybody saying that. It's actually something I agree with them. Usually when people say something that's been working for a long period of time is suddenly broken, it's people trying to convince themselves that something is no longer working. But he sits there and says something very interesting. He writes, ahead of the last 8 U.S. recessions, the average time between an inversion of the yield curve and the start of the recession has been 11 months. Over the past 4 recessions, the average lead time has been longer at 13 months. We're currently in month 8. It started in November of 2022. So it's about 9 months ago. So he's like, listen, I'm not worried about this right now. He's like, I still believe there's a recession coming or will be announced. And guys, it's funny. Here's what I will say. When people say, well, the job market's so strong. Yeah, but before every recession, the job market's strong. Before every recession, consumer confidence is strong. Employment and consumer confidence is going to be a lagging indicator. When things turn, unemployment, people are going to start laying people off more, saying, hey, we're seeing problems happening. And by the way, we've already seen that in the tech sector. The tech sector has already started laying people off. That started last year. So am I calling for a recession? Well, guys, eventually a recession has to happen. But the inversion of this yield curve is pretty interesting because logically it makes sense. People perceiving short-term problems being more at risk than longer-term problems. So I sit there and say, listen, on this channel, we try to teach financial discipline, living within your means, and properly saving and investing in long-term ETFs. If you do those things, you'll be fine. Even if you temporarily have a job loss. You know, people talk about emergency funds. I actually don't believe in emergency funds. And people would sit there and say I'm crazy for that. The reason being is you're spending a lot of time putting together at a young age all this money for an event that is less likely to occur. My personal belief, very unpopular, is you should have credit cards sitting on the side as your emergency fund for a couple reasons. Max out your 401k and IRAs. Those are tax deferred and they're untouchable by creditors. At least if you swipe a credit card, if things really go to crap, you can declare bankruptcy, which I'm not encouraging, but all your 401k and Roth IRA money is safe. So why take money out of your earliest years, your most important years of investing, to put aside making a few percentage points in interest? Put it in the market. Get yourself actively invested. Because in order to save 6 months of expenses, it may take somebody 3 or 4 or 5 years. That's going to cost you so much money down the road in retirement. I have a video out there that shows it's about a $1 million loss in retirement. If you haven't seen that video, it's very interesting. Watch it right here above. It'll really teach you that it's all about getting money in early as much as possible, and emergency funds don't do that. Now, with that said, if you personally sleep better at night, having a big pile of cash in your checking account or savings account waiting for emergencies, by all means, go do it. Because there's something way more valuable than money, and that's being able to sleep the next 30 or 40 years of your life properly. But in terms of this recession, Liz Ann Sonders, who I don't really care much for. I think she's just a salesperson. But she sits here and talks about this. She's the chief at Charles Schwab. A lot of people think the yield curve inversion is sort of a cause of recessions. That's not really one of the ways to think about it. It's the conditions that develop that cause the inversion of the yield curve that ultimately are the things that cause the contraction of the economy too. She is 100% spot on. She is 100% spot on. It's kind of like, when I say to people that leaving the milk out isn't what causes your divorce. It's the fact that you sat there and just didn't listen to your spouse over and over as they made a very simple request and they were finally sick of it. Those are the fundamental things that actually cause okay, we're done here. Same with the recession. Guys, recessions are a part of life. Recessions are part of economy. The good news is some of the best businesses are created during recessions, and it's a cleaning out process of crappy businesses. It allows us to sit there and clean the slate and start all over again. I don't like this. Now, remember, the government can sit there and keep writing checks to avoid recession. And at some point, though, something's got to happen. But the government could very well just do that. Hey, we're going to write checks. Everybody's going to get money. We're going to avoid a recession. But at some point, there's going to be too much debt. There's going to be a problem at some point. They're not going to be able to write that check anymore. Or taxes have to go up. It's going to cause a contraction. But you can kick the can down the road a long time. We've been doing that already for a while. So I'm not saying that as a doomsday. I'm just sitting there saying, guys, if you swipe the credit card for your mortgage every single month, eventually, you can keep doing it for a long time, but eventually you're going to have to sit there and say, I have no more swiping to do and I have no more money to back that up. The bank will eventually say, we're done here. Now, how long can that take for the US government? Years, decades. I have no idea. But the point is, recessions are a part of life. Don't fear them. Prepare for them. Make sure you are the most valuable person at your job. That way they keep you when there is a contraction. Make sure that's the case. Everybody watching this video, the fact that you're watching this video says that you're more proactive than others. That's awesome. Congratulations on that. So if you like what we're saying here, if you like my approach about looking at things, subscribe to the channel and also share this with somebody else out there who might find value in this. Thank you for your time.